Our knowledge series on corporate tax in UAE. The video covers following important matters: financial reporting standards, accruals and cash basis of accounting, accounting profit, tax period, allowable and disallowed expenditure, determining taxable income, specifically disallowed expenditure, dual-purpose expenditure, capital and revenue expenditure, entertainment expenditure, interest expenditure, general rule, value-added tax, contributions to a private pension fund, calculating taxable income. Introduction. In previous videos, it is explained who is subject to corporate tax and the basis of taxation. This video explains how taxable income is calculated. In the next videos we shall see further adjustments required to arrive at the final taxable income. The starting point to calculate taxable income is to find the profit before tax figure that is included in the statement of profit or loss. In order to reach a taxable income from profit before tax figure, certain adjustments are required with respect to exempt income, unrealized gains or losses, and the categories of expenditure explained in this video. After all the required tax adjustments, calculate the taxable income, which is taxed at the appropriate rate of corporate tax as per Article 3 of the Corporate Tax Law. According to the Article 2 Clause 1 of Cabinet Decision No. 116 of 2022, the portion of taxable income that does not exceed AED 375,000 shall be subject to a corporate tax rate of 0%. Financial reporting standards. Article 20.1 of the Corporate Tax Law states that the taxable income is determined separately, on the basis of adequate, standalone financial statements prepared for financial reporting purposes in accordance with accounting standards accepted in the UAE. Under the Article 20.1 of the Corporate Tax Law and Article 4 of the Ministerial Decision No. 114 of 2023, acceptable accounting standards depend on the size of the entity. If revenue is more than AED 50 million, financial statements must be prepared using International Financial Reporting Standards, or if revenue does not exceed AED 50 million, financial statements may be prepared using International Financial Reporting Standards for small and medium-sized entities, IFRS for SMEs. Under the Article 54.2 of the Corporate Tax Law and Article 2 of Ministerial Decision No. 82 of 2023, following are required to prepare and maintain audited financial statements: a taxable person deriving revenue exceeding AED 50 million during the relevant tax period, a qualifying free zone person. Accruals basis of accounting. The accruals basis of accounting is required to prepare the financial statements under IFRS. Accruals basis of accounting records revenue and expenditure in the period in which it is earned or incurred, which may be different to the period in which cash payments are received or paid. Under IFRS, all financial statements, other than the statement of cash flow, are prepared on an accrual basis. Accounting profit. The profit or loss statement summarize all of the company's income and expenses for a period and the resulting profit or loss figure, which is often used as the starting point for calculating taxable income. This figure undergoes various adjustments to arrive at a company's taxable income. The Other Comprehensive Income (OCI) statement comprises items of income and expense, including reclassification adjustments, that are not recognized in profit or loss as required or permitted by IFRS. OCI statement usually includes changes in the revaluation surplus, gains and losses arising from translating the financial statements of a foreign operation, gains and losses from investments in equity instruments designated at fair value through other comprehensive income, gains and losses on financial assets measured at fair value through other comprehensive income. The profit or loss and other comprehensive income statements of a company should be used as the starting point for the calculation of taxable income. Tax period. As per Article 57 of the Corporate Tax Law, a taxable person's tax period is the financial year, or part thereof, for which a tax return is required to be filed. The financial year of a taxable person is the Gregorian calendar year, January 1st to December 31st, or 12-month period for which the taxable person prepares financial statements. A taxable person can make an application to the FTA to change the start and end date of its tax period, or use a different tax period, subject to conditions to be set by the FTA. Under Article 2 of Clause 3 of FTA Decision Number 5 of 2023, for a change in tax period to be valid, the change may request to extend the current tax period to be a maximum of 18 months, or shorten the next tax period to be between 6 and 12 months. Exempt income. Refer our detailed video related to exempt income. Link is provided at the end of this video. Allowable expenditure. Allowable expenditure, deductible expenditure, is an expenditure which reduces the amount of profit which will be taxable to corporate tax. Under the Article 28.1 of the Corporate Tax Law, expenditure must meet the following two tests to be allowable. It must be incurred wholly and exclusively for the taxable person's business, and it must be revenue, not capital, in nature. According to Article 28.3 of the Corporate Tax Law, a single expense may be apportioned on a fair and reasonable basis into an allowable and a disallowable element where the expenditure is incurred for more than one purpose, including business and non-business use. For capital assets, expenditure is capitalized, that is, added to the book value of the capital asset, and relief is given via deductions from taxable income for depreciation or amortization over the economic life of the asset. Determining taxable income. Using the profit before tax figure as the starting point, various adjustments must be made to determine the taxable income and the corporate tax liability. Since the characteristic of the UAE corporate tax regime is business-friendly to ensure less compliance burden, therefore the adjustments to derive taxable income from the accounting profit figure are minimal. Under Article 20.2 of the Corporate Tax Law, adjustments may be required for the following. Any unrealized gain or loss, subject to election. We shall cover it in upcoming videos. Exempt income. Transfers between qualifying groups and business restructuring relief. We shall cover it in upcoming videos. Expenditure which is wholly or partly disallowed. Transactions with related parties and connected persons. We shall cover it in upcoming videos. Tax loss relief. We shall also cover it in upcoming videos. Any incentives or special reliefs for a qualifying business activity as specified in a cabinet decision. Any income or expenditure not otherwise taken into account, as specified in a cabinet decision. Any other adjustments as may be specified by the minister. Additions and deductions. Taxable person needs to ensure that all adjustments are made in the correct direction, that is, an addition or a deduction, which will ultimately increase the corporate tax payable, while deductions will lower the corporate tax payable. Disallowed expenditure. Expenditure which does not meet both elements of the allowable expenditure test, wholly and exclusively, and revenue, not capital, will be disallowable. Under Article 28.2 of the Corporate Tax Law, no deduction is allowed for the following. Expenditure not incurred for the purposes of the taxable person's business. Expenditure incurred in deriving exempt income. Losses not connected with or arising out of the taxable person's business. Such other expenditure as may be specified in a cabinet decision issued at the suggestion of the minister. Specifically disallowed expenditure. Under Article 33 of the Corporate Tax Law, following categories of expenditure are specifically disallowed. Donations, grants, or gifts to an organization other than a qualifying public benefit entity, which must be listed in Cabinet Decision Number 37 of 2023. Fines or penalties, bribes or other illicit payments, dividends and profit distributions paid to owners or shareholders in owners' drawings. Coverable input VAT. UAE corporate tax. Foreign taxes. If disallowed expenditure has been included in the accounts, it will add back to calculate taxable income. Under Article 10 of Ministerial Decision Number 116 of 2023, any expenditure related to acquiring or managing a participating interest is specifically disallowed. Instead, it is capitalized as part of the acquisition cost of the participating interest. Dual-purpose expenditure. According to Article 28.3 of the Corporate Tax Law, some expenditure will be incurred for more than one purpose, for example, where a company has both taxable and exempt income. Or a sole proprietor might pay some of their personal expenses through their business. Where this happens, the amount may be split for corporate tax purposes. This is a relaxation of the holy rule. The appropriate amount of expenditure will be allowable. It may be that there is a readily identifiable part of the expenditure incurred wholly and exclusively in generating taxable income. If not, an appropriate proportion may be determined on a fair and reasonable basis, having regard to the relevant facts and circumstances. Capital and revenue expenditure. Capital expenditure. Capital expenditure generally includes long-term investments in assets which are to be held for more than 1 year. According to Article 7.4 of Ministerial Decision No. 134 of 2023, an expense is capital expenditure if it is treated as such under the accounting standards used in the preparation of the accounts, for example IFRS. Revenue expenditure. Revenue or operating expenditure refers to day-to-day transactions for a business. Revenue expenses relate to the short term rather than years, and they are shown in the company's profit or loss account. A company needs to determine whether the expenditure is revenue or capital in nature. For example, purchase of a capital asset will be capital expenditure, repairs to a capital asset already in use will be revenue expenditure, and substantial additions or improvements to a capital asset already in use that increase useful life of an asset will be a capital expenditure. Amortization and depreciation. Amortization and depreciation are the expenses to account for a decrease in value of the assets during its useful life. Amortization is the term used for an intangible asset's value over its useful life, for example licenses, patents, and intellectual property rights. Depreciation is the term used for a tangible asset's value over its useful life, for example buildings and machinery. Both amortization and depreciation expenses are operating expenses and therefore deductible as long as the conditions related to deductibility are met. For example, amortization and depreciation expenses in relation to assets that are used to generate exempt income are not deductible. Amortization and depreciation expenses are not deductible if they relate to expenditure which would not have been deductible if it had been revenue rather than capital expenditure. Gains and losses on disposal. On disposal of a capital asset, it will generate either a capital loss or a capital gain, calculated as proceeds less net book value. As per Article 7.3 of Ministerial Decision No. 134 of 2023, any other associated capital expenditure that relates to the asset is also deductible from the proceeds as long as the cost has not previously been an allowable expense from taxable income. The resulting gain or loss is included in taxable income, unless exempt, for example the disposal of a participating interest. Entertainment expenditure. Entertaining expenditure by a business will typically have both a business and a non-business aspect. As per Article 32.1 of the Corporate Tax Law, a deduction is allowed for entertainment but is restricted to 50% of the total expenditure. Under the Article 32 of the Corporate Tax Law, entertainment is defined as any entertainment, amusement, or recreation offered to the business's customers, shareholders, suppliers, or other business partners. It includes, but is not limited to, the following: meals, accommodation, transportation, admission fees, facilities and equipment used in connection with entertainment, amusement or recreation. Such other expenditure as specified by the Minister. The 50% restriction on deductible entertainment expenditure does not apply to expenses incurred for staff entertainment. Employees' entertainment expenditure is fully deductible. Interest expenditure, general rule. According to Article 29 of the Corporate Tax Law, interest expenditure is allowable, within certain limits, discussed in the upcoming videos, in the period in which it is incurred. As per Article 10 of Ministerial Decision No. 126 of 2023, the deduction of interest expenditure is made after the accounting income figure has been adjusted in accordance with Article 20.2 of the Corporate Tax Law. Value-added tax. Irrecoverable VAT, that is the VAT business suffers on one of its expenses or inputs, which may not be claimed back via the VAT return, remains part of the total cost to the business. Under the Article 53 of the VAT Executive Regulations and Article 55.1 of the VAT Law, some VAT will be irrecoverable because it is specifically blocked from recovery, for example VAT on entertaining clients. Or some will become irrecoverable if evidence is not held to support a claim for input VAT, for example VAT on a purchase of trading stock for which the trader has failed to obtain a valid VAT invoice. Where irrecoverable VAT relates to expenditure, which is allowable for corporate tax, then the irrecoverable VAT may be claimed as allowable deduction for corporate tax. Where irrecoverable VAT relates to an expense which is not allowed for corporate tax, for example an item which is for 100% non-business use, then no deduction may be claimed for corporate tax. Contributions to a private pension fund. According to Article 5 of Ministerial Decision No. 115 of 2023 on private pension funds and private social security funds, a taxable person who is an employer may deduct the total value of contributions made to a private pension fund in respect of its employees who are pension plan members in the tax period in which such contributions are paid. The maximum deduction per employee is 15% of the employee's remuneration, which is deductible for corporate tax purposes in the tax period. This ends our video session. Subscribe to our channel and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.